Hey, my name is Jesse and welcome back to Stone Cold Investors. Today I'm going to be going over Dropbox, but before I do, please check out the description. I've got a timeline of the video with all the different chapters. I know these can get a little bit long, so please feel free to skip forward to whatever content you feel is most valuable. All right, first things first, let's go over the price action over the last 5 years, and we can see they went public right around 30, kind of consolidated, chopped, went up to about 42, 43 bucks. And then downtrended for a while from 2018 to 2020, and during the COVID crash hit around 16 bucks briefly in 2020. Uptrended to about $32 in October-ish 2021, and then we were downtrended to about $19 in April, May. And then we're sitting at about $22.98 currently. So now that we got that out of the way, let's jump into their latest investor presentation slide deck from, I believe, Q1. All right, so let's go into the Q1 investor presentation, basically the sales guide for investors of why we should buy their stock. We see, 700 million registered users, 800 billion pieces of content, just over 17 million paying users, and 80% of subscribers used for work. So this is what we kind of talked about. Cloud storage, 2007, backup sync, file sync sharing, collaborative environments, content management, professional sharing, secure sharing and analytics, project management, easy signature, content backup, all that good stuff. And then we go down and we can kind of see the products that they're working on. HelloSign, Dropbox, DocSend. So they're just saying, hey, we're designed for IT. We're designed for small business. We want to have a high retention rate, and we want to convert current customers, expand into additional products and grow that way. Convert and retain is their execution, and innovate new products. Boom. And upsell. Hey. So, just a brief introduction through Dropbox if you had no idea what they did or kind of what their business model was and how they have been attacking this. They've got family plans. I believe they have team, collaborative, and business plans. Yeah, Dropbox Business. Here we go. And interestingly, one of their products that I think is pretty interesting is Dropbox plus Command E, which is basically a universal search tool that allows you to search all of your different cloud environments or collaboratory environments. So they can basically API link into all of these different application sets, and you can have a singular area to search for all, across all your environments for documents, which is pretty interesting. So that's a quick rundown. And we can see here that they their goal is $1 billion in free cash flow by 2024. I'm guessing it's going to be, end of year, obviously, 2024. 30 to 32% non-GAAP operating margin. And they're kind of plan to scale. And with that, let's get over to the valuation sheet and see what we got going on over here. So before we get into that, let's look at their cash positions real quick. Total cash and short-term investments is about $1.7 billion. Total current liabilities is about $1.17 billion, and total liabilities is about $3.3 billion. And I believe that includes long-term leases that they're cutting back, and also some other acquisitions. Long-term debt, $1.3 billion, and $788 million in capital leases. So not too amazing, not too bad either. Short term, they've got plenty of cash on hand, but it would be nice to see that long-term liabilities come down a bit over time. So evaluation wise, let's just go over some numbers here. So we look at their revenue from 2018 over the last 4 years, and we've had about 8.8% growth. And these growth numbers are actually a little bit low because of how I'm calculating. I'm calculating the change and then I'm dividing based off the most recent number. So the actual growth rate is probably going to be a couple percentage points higher than 8.8%. So we can see revenue grew from 2018 from 1.39 billion to 2.157 billion in 2021. Gross profit, we had 997 to 1713. Operating income was negative 500, almost 500, 494 to positive 306. EBIT was negative 480 to positive 304. And net income was negative 484 to 335. And free cash flow, we saw a nice growth from 362 to about 707. So we can kind of see that the revenue and gross profit were growing at about 8% and 10% respectively. The operating income, EBIT and net income are kind of skewed because they went from unprofitable, or they went from negative numbers to positive numbers. So it looks like, law of large numbers, 65%, 64%, 61%. But the free cash flow is a pretty good one to go off of because they started at about 362, grew steadily to about 707, and that comes in at about 12.2% growth. And we can kind of see that it reflected in this chart down here. You can see that their historic margin rate across their products is about gross margins of about 80%. Free cash flow margins has been the best, about 33%. And then operating margins 15%, and net margins about 16%. But those margins have been improving over time. If we look at the historic bottom line yields, now this is kind of we don't have like a ton of data to go off of. It's not like we have 10 years of data to go off of, and they're just kind of flipping into a consistently profitable state across those bottom line metrics. So we kind of have to think of, what's a fair value assumption, or what do we think a fair value assumption is on the yield spread. But we can see kind of free cash flow yield is probably going to be the most consistent data because it has been positive since the 2018 metric, where we're not dealing with negative numbers on the EBIT and the net yield from 2018 on. So free cash flow is a good metric to go off of. And that yield spread, I believe, is about 3%. We'll confirm that up top. Historic shares outstanding. We can see dilution kind of going into about 2020, and then recently they have started buying back shares. And from 2020, they had about 414 million shares outstanding, and I believe they're at about 387 million shares outstanding right now. Yep, so they have been doing buybacks consistently. If we look at the numbers of that right here on shares outstanding, we can kind of see that they were dilutive, about 14%, and then about 0.6%, and then they had about 4.4% of buybacks in, I believe it's 2021, and trailing 12 months, they've had about 2% in buybacks. So they're starting to return capital to shareholders now through buybacks. And if we kind of look at the summary of our metrics right here. So the summary of our metrics was that essentially bottom line growth about 45%, but that's going to be skewed because I'm looking at all of those three bottom line numbers. Realistically, we could probably assume free cash flow growth the most of about 12.2%, right? So they're reaching this stage where as they grow their revenue and their gross profit, and they're becoming profitable, those net income EBIT numbers are going to moderate. It's not like they're going to be doing 64% consistent if they're only growing top line about 8% or 10%, 12%, whatever. So real bottom line growth, you can assume about 12%. That actually lines up. If we look at the base case, that lines up with their goal of free cash flow of $1 billion by 2024. And if we look at see this bullish scenario, I've got 12.5% growth, and we go over to that bullish scenario over to free cash flow. Estimated free cash flow at a 12.5% annual growth rate gets us to about 1.007 billion in free cash flow by year end 2024 in the bullish scenario. And that's basically what management is targeting and guiding for us. And at that point in time, we'd be looking about 21%, actually no, 26% KGAR if we hit these yield spread rates. So let's go over the assumptions real quick. Currently, I have a margin of safety 5%, base KGAR target of 15%, total target rate's 20%. If we look over the different scenarios, okay, so for these scenarios going from very bearish, which is worst case, hopefully worst case, to best case, the yield spread that I'm using would be 5% to 2% yield spread, risk-free rate would be 5% to 2%. So we have risk-free rate of 5% going down to a risk-free rate of 2% for the very bullish scenario. And that risk-free rate I take as the 10-year treasury yield. On a dilution basis, now we can see that the 4-year average, they've diluted 1.88% per year, but we know that was kind of front-loaded, and they've been buying back as their free cash flow has increased. So now we, I'm estimating 1% dilution for the very bearish and about 3% buybacks for the very bullish. Bottom line growth, remember, about 12.5% is our bullish scenario, and that's what management is targeting. And so for base scenario, I use 10, then we have bearish 8, very bearish 6, and a very bullish scenario of 16. So we have a range of 6% growth bottom line to 16% growth bottom line from very bearish to bearish, or very bearish to very bullish. Yield spread. Now, we know that the EBIT and the net yield spreads have been running at a negative. But we're not going to project that going forward as we do our estimates, as they're flipping to profitable on a bottom line basis. So we're going to be looking at a very bearish case of 1.5% yield spread for EBIT and net yield, and trickling down to a very bullish case of a 0.5% yield spread. Now, free cash flow is a better metric to go on because we have more historic years of positive data to give us a better, realistic free cash flow yield spread between their free cash flow and the risk-free rate. We can see that was about 3.05%, so we're going to assume that that stays the same for the base case. And so we're assuming for the base case that we get about a 3% yield spread, bearish case 4%, very bearish 5%, bullish case would be 2%, and very bullish would be 1%. So we would have margin valuation expansion, multiple expansion if it went down to that 1% area. All right, so given our assumptions, we can see that our 2026 estimated fair value is anywhere between 1853 from a very, very, very bearish standpoint to 103.44 from a very bullish standpoint. So most likely we're looking at a value somewhere in the range of 26.57 from a bearish case to $60.71 from a bullish case by year end 2026. Now, if we're trying to get a 20% compound growth rate on this, and all of these assumptions are kind of correct, typically I'm going to want to pretty much make sure I'm getting 20% through my base case. We can see right now, even in the bearish case, you're still at about 2.9% KGAR and going up to 21.44% KGAR on the bullish case. And remember, the bullish case is the one that kind of is probably most aligns with management as far as their free cash flow goals by 2024. And then it assumes they're going to keep that consistent rate of growth of 12.5% to the bottom line through 2025 and 2026. Okay, so currently, a price of $15 would definitely get us there as far as a target rate of 20% KGAR. That would get us there through the base case. So that would be like the most ideal scenario. Realistically, though, we know that Dropbox has a pretty hard time breaking 19. So if it got down to 19, we can still see that if it got down to 19, then even in our base case, we're still kind of projecting a 15% KGAR. And then if the bullish case comes true under these different valuation circumstances, we could see potentially a 26.15% KGAR. But obviously, all of this is dependent on your assumptions, and if your assumptions are different, all of these numbers are going to be different. And then whatever happens in the future, obviously, is going to dictate what actually happens. So, hey, I hope you enjoyed the content. If you did, please hit the like and subscribe, and we will see you on the next evaluation video.